talking about the presidential puzzle, Trump's win, and what does it mean for expected stock returns. It's a pretty fun topic.
Yeah,
Uh,
we're recording this on November 20th, and I don't know that you were going to cover this explicitly, so apologies if you were. But like we saw, as soon as the election was finished, markets just went on an absolute moonshot.
yeah,
And as of today, I think they're back to where we were pre-election.
yeah. So it tends to. There's a paper that I looked at on this that because the theory is because Republicans tend to enact favorable tax changes for corporations, there tends to be a bump in asset prices after Republicans are voted in. Yeah, that it's a relatively small effect though, much smaller than the effect that we're going to talk about in the episode. Okay, so Donald Trump obviously won the 2024 U.S. presidential election, and he's now set to become the 47th president of the United States. There's some other interesting stuff about him. Like I think he's the only non-consecutive two-term president ever. Someone might tell me I'm wrong on that, but I'm pretty sure I read that. Now, the interesting thing is that this Republican victory likely contains information about expected stock returns, but it's probably not the information that people expect to hear. Like I mentioned, Republicans being relatively business friendly. And I think people often assume that Republicans are good for the stock market, and they're not bad for the stock market. And the causality is really interesting, and we'll talk more about that. But the empirical fact, the interesting empirical fact that makes this whole discussion interesting is that the historical equity risk premium going back to 1927 has been much higher, like much higher under Democratic than Republican presidents. So that's the presidential puzzle. There's one big paper, I think in the Journal of Finance, that identified this. And then Lubosh Pastor later had a paper that confirmed the same thing out of sample, and they put some theory to it, which is what we're gonna talk about. And I think because there's this theory behind it, and if you look at the way the world looks today, it looks a lot like kind of what this theory would predict. I think it has just interesting implications for expected stock returns. Now, the other thing I think is really interesting here is that everyone's going to have a different opinion on what the election results mean for the stock market. Like, I don't know, man. Politics are so polarized at the moment in the United States and in Canada too. But in the United States, like each side of the political spectrum in the U.S. seems to think that the other side is like completely brain dead.
Well, it's like it's gotten to the point where it's an insult to call somebody a member of
Right.
the party.
Yeah.
Like stupid Dems or stupid liberals or
Yeah,
whatever.
yeah.
Right? Like, and everybody just puts you in an identity box based on your
That's
politics.
right. Yeah, there's so much identity wrapped up in this stuff. And so, a Democrat might think, well, Trump is going to crash the stock market, and a Republican might think that Trump's going to be super good for the stock market. Everyone's got their own opinion, but the problem with this is that everyone's got their own opinion based on their individual model of the world, based on how they see it through their own lens as a Democrat or a Republican. So this is separate from the presidential puzzle, but it's still super interesting, and it ties back. So there's this 2020 paper, Belief, Disagreement, and Portfolio Choice. And they find that households likely to be Republican, likely to be based on their geographic area and what proportion of people in that area vote Republican. They increase the equity share and market beta of their portfolios following the 2016 presidential election when Trump won. And likely Democrats, likely in the same way, they rebalance into safe assets. So Trump wins, Republicans take more equity risk, increase their equity beta, Democrats rebalance into safe assets.
Wow.
Yeah, it's fascinating. Right?
That alone is super interesting.
Yeah.
That
It
just
is super
shows
interesting.
how disparate the viewpoints are amongst those two
Yeah.
groups. Right?
Yeah. And how important it is to have like an objective view of this stuff. So this is a paper by Antoinette Shore at MIT. We discussed it with her in episode 310 if people want more details on that paper. So they control for multiple factors to rule out non-belief based explanations for that observation. And they conclude that the behavior is driven by investors interpreting public information using different models of the world. And now it's obvious when you think about it because of like what we just talked about, like it's an insult to call somebody a Democrat if you're a Republican. It's so polarized. So it's kind of obvious that people would have such different beliefs about what like factual events mean. So Democrat households in 2016, like they believed Trump was going to crash the market and they went to cash or they reduced their equity exposure. Republican households believed Trump was going to send the stock market on a rocket ship, and they increase their allocation to stocks. But the problem, obviously, is that individual beliefs, like they can't all be right. Individual beliefs are not a great model for how the world actually works, and making decisions on that basis can lead to errors. So this is where the more robust model that explains the presidential puzzle, I think, gets pretty interesting. So again, the empirical fact to start is that the vast majority of the historical U.S. equity risk premium has been delivered under Democratic presidents. One important distinction that I'm going to make later, but I'll make it now as well, is that we're talking about the equity risk premium. That's the return of stocks over the return of 3-month treasury bills, not equity returns. Those things are sort of related, but they're distinct. So we're talking about the equity risk premium here. And I'll come back to that later. So this is a 2020 paper in the Journal of Political Economy by Luboš Pastor. It goes up to 2015. I looked at data after that just to see how it fits with the model. We'll talk about that in a second. We did discuss this paper with Luboš Pastor in episode 124, if people want to go back and listen to that one. So the headline empirical result from the paper, and this is the crazy data point, is that from 1927 to 2015, the average market return in excess of 3-month treasury bills under Democratic presidents is 10.7% per year. And under Republicans, it is negative 0.2% per year.
That's so big.
So literally all of the equity risk premium over that period
that's wild.
Came under Democratic leadership.
Yeah.
Crazy, right? And I think that's surprising to people. I know it was surprising to me the first time I read that when we were preparing to talk to Luboš back then.
Well, not only that, but you see all these posts on social media and people writing articles about how it doesn't really matter who's in power when it comes to market returns. And maybe over the long run that ends up being true, but there's obviously a difference.
Well, yeah. And I'm going to say something like that later too, because like stock returns in absolute terms, as opposed to the equity risk premium, have been positive most of the time, like on average through both presidential parties. But still, this empirical fact is important. And the theoretical explanation, I think, is the really interesting part. So I'm going to get there in just a second, though. So that return difference, the difference in the equity risk premium of around 11% is obviously economically significant. It's also statistically significant. They look at that in the paper. Now, stock returns under the most recent Republican, which is Trump, and Democratic, which was Biden, presidential terms do not fit with the model. And you go look back at all the historical presidential terms that are in the model. They're not all perfect. It's just like on average, this is what it looks like. So the equity risk premium under Trump was an annualized 14.4%, and it was 9.12% so far under Biden, ending October 2024. So no model is perfect, obviously. Like we can't use a model, even if it's a good one, to predict the future every time. And I'm going to come back to just that idea a little bit later. When I include those data, as a Bayesian would do to update their beliefs in the larger data set back to 1927, the overall results stayed directionally the same, where the average equity risk premium under Democratic presidents far exceeds that of under Republicans. So updated to October 2024, so from 1927 to October 2024, I get an equity risk premium of 10.29% annualized on average when the president is a Democrat, and 2.23% when they're a Republican. So still a massive difference, just not quite as big. The first time this was identified was in a 2003 paper. That's the Journal of Finance paper that I mentioned earlier, titled The Presidential Puzzle, Political Cycles in the Stock Market. And then Pastor in the 2020 paper finds that it persists out of sample. So in their out of sample period, it fit perfectly. Like there was a big return difference or equity risk premium difference again. Now here's the interesting part. The tempting explanation is that the different economic policies of the two parties explain the difference. Mm-hmm. Like that. I mean, that's like the polarizing political explanation is like, well, Democrats are better for the stock market.
Well, it seems obvious. Like at first glance, what else could it be, right?
Right. And it's a classic case of causation versus correlation, or correlation not being causation. So the causal relationship is the really interesting part. Now, of course, markets don't really work that way. If economic policies really had that much of an effect, the expected effect of those policies get quickly reflected into asset prices. And we wouldn't expect these big persistent return differences. That explanation, the policy explanation, would kind of imply that investors persistently misprice stocks by failing to anticipate the expected policy effects. And then they get surprised by, wow, that was so much better than we expected. But the simpler explanation that Pastor offers in Political Cycles and Stock Returns is that Democrats tend to get elected when expected future stock returns are higher, and Republicans tend to get elected when they're lower.
Mm-hmm.
So
does that also mean the markets generally are like lower or down or cheaper, I guess?
Yeah. So I'll talk a little bit about that. So one of the reasons that could happen, that expected returns could be higher, is that investors' risk aversion, it varies over time depending on what's happening around them. So if we take risk aversion is probably high during an economic crisis, as one example. Mm-hmm. When risk aversion is high, investors demand more compensation for risk, which on average over a long period of time is going to play out as higher realized returns. Now, how this relates back to politics, and this is a really interesting part of the paper, is that when risk aversion is high, like during an economic crisis, voters are more likely to elect a Democratic president because they demand more social insurance, which Democratic leadership tends to provide. Mm-hmm. And then when risk aversion is low, like during a booming economy or a booming stock market or both, voters are more likely to elect a Republican president because they want to take more business risk.
So it does kind of tie into policy to a degree then, right? Like in that they're reacting to external events like what's going on in the economy and the markets in order to make decisions about the policies that they want to vote for.
Yes, but instead of policies causing the stock market to perform a certain way, the stock market, risk aversion causes certain policies to be favored and causes expected stock returns to vary. So the causal direction is the key to the paper here, and I think what makes it interesting. So the result is what we see, that when Democrats get elected, risk aversion tends to be higher, which leads to higher expected stock returns under Democratic leadership. And when Republicans are elected, risk aversion is lower, leading to lower expected returns under Republicans. Now, an important thing is that in this model, Democratic presidents, they're not the ones causing high expected stock returns. I guess I'm kind of reiterating what we just talked about, but high risk aversion causes both Democratic presidents to get elected and expected stock returns to be high at around the same time. And then it's a similar story under Republicans, just in the opposite direction, I guess. They don't cause stock returns to be low under their leadership, but low risk aversion tends to result in Republican presidents getting elected and expected stock returns to be low at the same time. Now, in the paper, they go back through history and they just look at like how does this idea, they do some other interesting stuff to kind of confirm that risk aversion does tend to be high when Democrats are elected, like separate from the stock market. They look at other measures of risk aversion, but they also just look at go back through past elections and how does the model look. So they look at November 1932, amidst the Great Depression, Republican Herbert Hoover lost the election to Democrat Franklin Roosevelt. Kennedy gets elected during the 1960-61 recession. Carter gets elected after the 1973-75 recession, a Democrat. Clinton, a Democrat, after the 1990 to 91 recession. November 2008, of course, in the depths of the great financial crisis, Obama beats McCain. Democrat Obama beats Republican McCain. And then in 2020, everyone remembers this one more recently, Democrat Biden beats Republican Trump as the U.S. and everybody else is dealing with COVID-19. So that one wasn't in the paper, but I mean, it's a pretty obvious one to add. And then in 2024, I mean, this is where I think it's just so interesting to see how well the model maps to what we see happening. The U.S. economy looks objectively great. U.S. stock prices are nearing like all-time highs, and Republican Trump beats Democrat Harris. Mm-hmm. So I mean, I don't know. Like you couldn't make this up. It just seems so perfect relative to what they describe as their model.
Yep.
And then they look overall. They kind of look at the data of when do transitions from Republican to Democrat happen, and they find that they tend to be preceded by this. To your point earlier, Mark, they tend to be preceded by low market returns, low GDP growth, and high volatility. They also look. I mentioned this a minute ago. They look at the time series of 4 proxies for risk aversion. And they find that they indicate that risk aversion tends to start out high and then decline over the course of a Democratic presidency. And those are measures of risk aversion that are not directly related to the stock market, or they're not derived from the stock market, I guess. And another interesting thing is that change in risk aversion contributes to such a large gap between returns under Democrats and Republicans, because as risk aversion reverts to the mean after a Democrat is elected, expected returns are falling, but that's also causing stock prices to increase over that term. So fitting with this model, I mean, Trump is likely going to be inheriting a stock market with incredibly high valuations, which I would say suggest low risk aversion in the market right now. And that's again, that fits with the model. Republicans are most likely to get elected when risk aversion is at its lowest, which is often at the peak of the business cycle. And so it's not surprising, and they observe this in the paper, it's not surprising that they observe a downturn shortly after Republicans take office. That's not a surprising thing to see. So there does tend to be that little bump that I mentioned from maybe favorable tax policy expectations, but that there's often a decline after they take office. Another thing the model predicts is a larger gap in the early years of presidential terms, which is exactly what we see in the data. So in the 1927 to 2015 data series from the paper, the gap in returns is by far the largest in the early years of presidencies. So I think this model is like pretty relevant today because the U.S. economy is like, it's doing well. Stock prices in the U.S. are high, which I guess suggests risk aversion is low and that expected returns are low. Vanguard and PWL and like, I mean, anybody that creates expected return assumptions, everybody's expecting U.S. stock returns to be relatively low going forward because valuations are so high. The tax thing, I've got some notes in the tax thing it's worth mentioning. So that, it's basically that there is that little bump from potentially favorable tax policy, but it's dwarfed by this presidential puzzle. It's not even close in magnitude. So that's the main idea. Now, what you should actually do with this information, I mean,
short
it's
US
interesting.
Is what you're saying.
What's that?
Short U.S. stocks is what you're saying.
Well, so this is the thing, right? Is it like if we did this episode, or if you listen to Lubash Pastor's episode where he describes this model back in episode 124, whenever that was, I think it was around the time Trump was getting elected, because I think we talked about that. But if you had listened to the model back then and said, okay, well, I'm gonna do that, I'm gonna act on that information. I mean, Trump, as we mentioned, the returns under Trump, his first term were incredible, and they've been great under Biden too, but not as great. So it's like you have to have a lot of confidence in a model, which you probably shouldn't have, but you have to have a lot of confidence in it to make asset allocation decisions based on that model. I think there's just too many other variables, other factors that can affect actual outcomes. So like over the next, 100 years, there's a good chance I think that this model is predictive, but over any individual presidency, I think it's tough. Yeah. And then the other thing that I mentioned earlier is that this is looking at the equity risk premium. So that's a premium for owning stocks over short-term government bills, in this case, 3-month treasury bills. But raw stock returns, like if you just look at have stock returns been positive, they've been reliably positive on average under both Democratic and Republican leadership. So we're not talking about like, you're not going to lose money necessarily. I mean, we might have a market crash. I don't know. But we're not saying that on average you should expect to lose money by staying invested when Republicans are in power. It's just that the risk of owning stocks has been better compensated while a Democratic president leads the country. But stock returns have been reliably positive no matter what.
So don't short U.S. stocks is what you're saying.
I don't think so. I don't think you can use this to time the market.
Yeah.
I don't think so. I mean, that most recent out of sample period that I did the data for, like it kind of proves that point, right? Like if we had this paper and we said, okay, we've got this model of data to 2015, let's implement this strategy. I mean, you got wrecked.
Yep.
As often happens with back-tested strategies. So I think that's an issue. Even a good model that has been historically successful at explaining differences in returns, it's not a perfect guide for future decision making, especially for something like this. Like I love the test for a strategy of what happens if I'm wrong, right? Like with the dimensional funds that we use, they own the total market. They're slightly tilted towards small cap and value stocks and high profitability stocks relative to the market, but they still are based on market capitalization weights, just with some adjustments. So what if I'm wrong? What if there are no return premiums? Well, it's not really that bad. But if you short US stocks and you're wrong, like you get destroyed. Or if you exit the US market, we could have had the same conversation 5 years ago or something. Valuations are super high, blah, blah, blah. And then the US market's just like a rocket. So I think it's really hard to do anything with this information. However, I think in the other direction, it's worth being careful in light of this model. I mean, again, this is just a model. It's not perfectly predictive. You shouldn't probably make major asset allocation changes on it based on it. But believing that the incredible recent US stock returns are going to persist forever at a time when valuations are high and risk aversion is low, and this model about, presidential elections suggests that, hey, maybe expected stock returns are low right now. I don't know if I'd be going all in on US stocks just as much as I don't think I'd be shorting them. So I think that's another important thing to think about. Diversification is always important. It's like an umbrella, and you don't want to have to buy an umbrella after it starts raining.
Yep.
So if we step back and look kind of objectively at the empirical data, there is this puzzle. The puzzle's there. The equity risk premium has been much higher under Democratic presidents than Republican presidents, likely due, based on the Pastor paper, to time-varying risk aversion, causing expected stock returns to be high when Democrats are elected and then low when Republicans are elected. While that may make market timing tempting, no model's perfect. And the reality is that while the equity risk premium has varied, average stock returns have been reliably positive through political cycles. There's a great chart that we have that Dimensional Fund Advisors made. They posted on their website, so we can show that in the video. But it just shows, like, over time, markets have just kind of gone up, and they've gone up whether it was a Democrat or a Republican in power. Yes, there was more equity risk premium under one party than the other, but like, you can't time that, and expected returns are positive no matter what. So, I mean, whatever. You got to stay invested, stay diversified. Politics can get super emotional, as we've seen pretty clearly, just everywhere. But and in that 2020 paper by Antoinette Shore, that shows it in such an interesting way. But you can't let your individual beliefs cloud your judgment. One point actually on the Antoinette Shore paper is that they do find that, and they look at this empirically, the best ways to reduce the impact of individual beliefs on investment decisions. One of them is the best way is to delegate your portfolio management. And that can be done either with an automated investment product, like an asset allocation fund, or through a professional financial advisor. So they find in the paper that both of those things reduce this belief-based action on portfolios. All right, that's it.
Super. So I've lived, I'm sure you guys have too, and everybody who's an advisor listening to this has probably been through these exact conversations with clients. But I had this exact problem with a client in 2016 when Trump was elected. So these clients, they were the physician household. They had about, I think it was just shy of like $5 million invested. So it was quite a bit, but they were 90% fixed income. So very, very, very conservative investors. They were probably in their late 50s, I think maybe early 60s. So gearing up for retirement. So maybe risk aversion was higher for them personally at that time as well. But they were always very, very conservative, like lots of GICs, tons of fixed income. So they had about 10% total exposure to global equity and only about somewhere around 4% in US stocks, 4% of their portfolio in US stocks. And she called me like, it was something like 2 days before the 2016 election, full on panic, sell everything, Trump's going to win. I'm like, okay, well, hang on, like, let's back up here. Like, sure, he might win, but like, so what? She was convinced that not only was he going to win, but as a result, the market was going to absolutely crater, right? And it was a really difficult conversation because on the one hand, you're trying to explain you don't really have that much exposure. Like, you don't have, it's 4% of your portfolio. If it went to zero, you're talking about a 4% loss. Everything is in super safe investments, GICs and fixed income. But to your point, like what if you're wrong? Like you can predict the event properly and be correct on like some binary outcome, but not predict how the market's going to react to that
That's
event
right.
properly.
Yeah.
And that's of course exactly what happens. Like I pleaded with her and I just couldn't win that discussion with her. And I said, you know what, if it's a sleep at night decision and you're more comfortable, and knowing of course that it was not, the opportunity cost of her being wrong wasn't that high, just because their exposure to stocks in general was relatively low. It's like, fine, let's do it. So we sold the whole 10% equity sleeve of her portfolio and went to fixed income with it. And of course she was right. Trump won. And the market just went on an absolute tear, right? I think I looked it up yesterday, and from the time she made that decision to the time I left that role, so I ended up leaving that role and handing that client off to another advisor. And at that time, she had still not got back into stocks. And this was in like January of 2018. So you're talking 13 months, 14 months between the time she sold and between the time I left. So I don't know what the eventual outcome was, but at least over that 13-month period, she hadn't gotten back into stocks in general, and specifically not US stocks. I looked it up yesterday, and the S&P 500 was up like north of 30% over that time frame. So opportunity cost was massive. And going for the full 4 years of that particular term, 2016 to 2020, the S&P 500 in US terms, in US dollar terms, was up 80%. So assuming she never got back in, that was the cost of making that sort of irrational decision. And again, their exposure was relatively low, so the upside wasn't huge in dollar terms, but it just goes to show that making emotional decisions around, predictions about what markets might do because of some event is a very dangerous way to manage your money.
Oh man, we had to, not so much this time, which is interesting. I don't know why that is, but in 2016, Trump was like, people couldn't even believe that he'd gone in like to run for president, and he did it and he won, and everyone's like kind of mind blowing. Maybe this time because he's already been there, but this time's even crazier though. Anyway, well, we didn't get many calls about it this time, but back then we got a lot of calls from people with the exact same sentiment. Like, this is crazy. The market's going to crash. And of course, like you mentioned, it didn't. I think the other really important point in your story though, is that market timing, you don't just have to be right once.
Yep.
Because even if it had crashed, right? Even if the market had crashed, you have to be right twice.
Yep.
You have to get out at the right time, and you have to get back in at the right time. And getting back in, I mean, I've heard stories. I don't have clients that are in this situation, but I've heard stories secondhand from other advisors of clients who got out of the market in like the 2000 tech crash and still to this day have not gotten back in.
That's just it. And if they were right and it does crash, it's still really, really difficult to get back in because you're at the hard ride edge of this drawdown in the markets. You're like, no, it's going lower. So
and people never want to get in after the crash.
And when it bounces
they wait
back
until
up,
it recovers.
like, no, this is a dead cat bounce. It's going to drop again, right? And then it just keeps going up. And then now what? Like you're handcuffed. You don't know. You're paralyzed. Yeah. When do you get back in? So even if you got it right on the sell, like you said, you have to be right twice. And whether you're right or wrong the first time, it becomes very, very difficult to get back in. Whether the market does go down and you were right, or whether it goes up, it becomes emotionally and psychologically very difficult to time it back in.
Yeah. Yeah, so I definitely don't want people to interpret the differences in expected returns under different types of political parties in the United States as a suggestion that market timing makes sense. I think we're pretty clear about that. But I think it's just a really interesting point. And probably my biggest practical takeaway from it is like continuing to expect that the recent U.S. market performance is going to be like, that's just it. That's the future. Like, I think that's a big mistake. And again, I'm not saying that you should not own US stocks or that you should short US stocks, because those have, I would argue, greater risks. But I think the most reasonable way to use that information is in setting your expected return assumptions. Don't assume the US is going to keep returning 10% a year nominal forever, or it's even higher in recent history. So I think we'll see. I've said similar stuff, at various points in the last 10 years, and the U.S. market has kept going up. So
you've been wrong before, Ben? Is that what you're saying?
I've been wrong so many times on that one. Anyway, yeah.
Yeah, no,
all right. So
point. I think like you're not doing anything with your portfolio with this information, are you?
No, not at all. I mean, I just don't. I don't see how you reasonably could.
Yeah.
It's just too. There's too much uncertainty. And I mean, that the example of 2016 is such a good one, where if you got out of the market, even with the past store model of like, hey, expected returns are probably low right now, if you got out of the U.S. market, then like you got absolutely wrecked.
Yep.
Even if you got back in under Biden, I mean, you still got some positive returns at least, but you missed out on a huge chunk of the equity risk premium over that period.
Yep.
So,
well, and if it was a perfect model, then there'd be no difference, right? Like it'd be arbitrage anyway. So it can't be a perfect, predictable model.
If it was a perfect model, it would just be reality, and reality would adapt to itself. I don't know.
Yeah. Yeah. Really interesting.
Yeah.
You should do the same thing with Canada at some point.
What's that?
I said you should do the same thing with Canadian data if you can at some point. Like
obviously, the US is the big market. I had it in my notes. I don't know. I guess I must have taken it out at some point. But I did have it in my notes that they test this. Where did that go? Hold on. I must have deleted it to trim it down or something. Let's see if I can find it real quick. But the thing is they do look at it for other countries, but not for other countries' political parties. They use U.S. political parties as a proxy for global risk aversion. And they just argued that the U.S. is such a big player economically around the world that it's probably reasonable to assume that there's a relationship between global risk aversion and U.S. presidencies. And so they test that, and they do find in Canada was in there, and I want to say Australia, Germany, maybe the UK. I'll keep seeing if I can find it here. But they do find that there is the same relationship for all of those countries, for all of the other countries that they look at.
Interesting. So people in foreign countries, their risk aversion is, the returns. All eyes are on the U.S. basically.
That's
foreign investors.
Kind of what they're saying.
Yeah, that is really interesting.
I guess I took that out of my script, which I'm kind of regretting now because it was a really interesting point.
Yeah.
But yeah, so they do test it in other countries just for robustness of their model, and they find the same effect as there, which is I think pretty interesting.
Yeah, it would still be interesting to see it with Canadian politics, but I wonder if Canadian politics largely follow U.S. politics, like if we were more right or left wing leaders at the same time as
I have no intelligent comments on that.
Yeah, no,
I don't know. I'd be interested too, for sure.
Yeah.